You know, the story of money is maybe one of the oldest human stories there is.
It really is.
It shapes every single market, every government, and honestly, every life decision that you make. But what if? What if the entire thing, this huge, complex global financial system we all depend on, what if it's actually nothing more than a powerful but really fragile story we all just agree to tell ourselves?
And that's exactly what we're doing today. We're on this massive deep dive, a kind of intellectual journey that covers 4 years of intense research, a lot of global travel, and even time spent working right inside the highest levels of global finance.
So what's the mission here?
The mission is to get some real financial clarity, to get insight into a system that, for most people, just feels unstable, impossible to understand, and maybe even rigged.
And we're looking at this through a really unique lens, aren't we?
A completely unique lens. We're following the path of a highly educated professional. I mean, someone with serious credentials, law, political science, business, the full package. And this is a person who climbed the ladder of traditional finance.
Right, from the really intense sort of structured world of investment banking and derivatives desks.
Yeah, and then straight into the, glittering, super high-stakes world of venture capital for celebrity acts. We're talking Linkin Park, the Chainsmokers.
Yeah.
But what's so striking, which just jumps out right away, is this profound cognitive dissonance at the center of that life.
What do you mean by that?
Well, this person had all the external signs of success, right? Doing deals in New York, London, Dubai, advising clients with millions of dollars.
The dream life, on paper.
Exactly. But underneath that shiny surface, that glamour, her personal reality was, frankly, terrifyingly precarious.
It's just incredible. The source material lays it all out, that by early 2020, even while she's advising global icons on how to create massive wealth, she felt perpetually broke. She was struggling under, over $50,000 in high-interest credit card debt?
Yeah.
And felt totally locked out of buying basic things like a home or even just a reliable car.
And that's the ultimate paradox that just forces you to ask the question.
Yeah.
How can someone who is literally helping create millions, maybe billions, for other people be simultaneously trapped by the very system they work inside?
That's the core of it.
That personal crisis,
Yeah.
Feeling empty-handed, even with all that insider knowledge, that's what drove her to question everything, all the fundamental assumptions of modern finance. And that's what kicked off this whole study.
So this individual quest really collided with a global one in March of 2020.
Oh, completely.
Stability wasn't just threatened anymore. It completely shattered. When President Trump announced that unprecedented closure of the American border to European travelers, a decision that, cascaded into global lockdowns in like a week, it was a signal.
A huge signal.
It signaled that even the most stable nations were suddenly putting national survival way ahead of global integration.
And the physical reaction to that uncertainty was so profound, and it was the same everywhere.
The panic buying.
The panic buying. The source describes rushing out to get non-perishables, rice, buckwheat, ramen, canned goods. This desperate, almost unconscious attempt to control something that was totally uncontrollable.
And the author suggests this wasn't just, rational pandemic prep.
No, not at all. It was something deeper, a kind of genetic memory activating, this subconscious fear passed down from ancestors who lived through, say, WWII rationing or the intense food shortages of the collapsing Soviet system.
And the U.S. wasn't alone in this sudden, really strict state control.
Not by a long shot. We saw governments all over the world use their power in ways that, most people alive today had never experienced.
Like in Russia.
Russia was threatening imprisonment for anyone who violated lockdown orders. China used all this sophisticated tracking, tech phone apps, facial recognition, to monitor and control the movements of its entire population.
And India, I remember, imposed a mandatory 21-day homestay on 1.3 billion people.
1.3 billion. So the whole story of decades of globalization and, seamless free trade, it was silenced overnight.
Really?
Replaced by these highly policed, isolated nations.
And this sudden reliance on state power, combined with the huge economic contraction, it just poured fuel on existing social tensions.
It was a tinderbox. And just 2 months later, May 2020, the death of George Floyd ignited mass demonstrations, protests, riots, huge-scale looting in over 140 American cities.
And internationally, too.
And international capitals, yeah. The visual brutality of it, shared instantly on social media, just exposed this deep, simmering discontent that had been there for years.
To really get the implications of this widespread unrest, we have to look back a bit at the philosophical framework of modern government.
Right, and the sources take us straight back to Thomas Hobbes's big work from 1651, The Leviathan.
Right.
Hobbes argued that life without a government, what he called the state of nature, is solitary, poor, nasty, brutish, and short.
Pretty grim picture.
Very grim. So to escape this, citizens enter into a social contract. They give up certain freedoms, they agree to follow the state's rules, and in return, the Leviathan has to fulfill its side of the bargain.
And that bargain includes critical obligations.
Critical ones, providing security, education, and economic welfare.
And what the crisis of 2020 really laid bare was that in the U.S., the government fell critically short on delivering on these core promises.
Yes. For a huge percentage of the population, it challenged the social contract itself.
So let's break that down. The first failure was security.
Absolutely. The high-profile instances of police brutality and the subsequent lack of accountability, it just severely eroded public trust in law enforcement.
When communities feel that the people meant to protect them are actually perpetuating violence or injustice,
then the whole agreement to follow the rules starts to break down. You see a rise in, self-policing or, on the other hand, just outright defiance.
Okay, so that's the first failure. The second was healthcare.
A vulnerability that the pandemic just brutally exposed.
Because the U.S. is still the only developed nation without a universal public healthcare system.
Which forces millions of people into this really expensive, profit-driven private insurance market. And the pandemic didn't hit everyone equally. It was merciless in highlighting this inequality.
How so?
Well, people in lower socioeconomic brackets, the ones often working essential, in-person jobs, living in closer quarters, relying on public transport, they suffered the highest rates of infection and death.
They were the most exposed.
The most exposed and, at the same time, the least likely to have the insurance or the financial cushion to handle a severe illness. The system was just starkly revealed to be structurally biased against the poor.
Right, but as important as those first two failures are, the source argues that the third one, the economic failure, is the most profound.
It is. It's the central catalyst for this whole deep dive.
It's the perception that the financial system is just inherently rigged.
Yes. That it's impossible for huge parts of the population, even highly qualified professionals like the author, to build any kind of lasting stability. That's what forced this serious interrogation of the very nature of money itself. Why does it generate so much anxiety and so much inequality?
To answer that, you have to start, not on Wall Street, but with history.
Exactly. The author's childhood in the Soviet Union provided this early, brutal lesson in just how impermanent money can be. I mean, most of us assume our governments, our currencies, they're eternal.
Right. But the author was just about to turn 4 when on December 25th, 1991, the Soviet Union just dissolved.
Just gone. A global superpower that had defined half a century of global politics vanished overnight.
Experiencing that as a child must have instilled this powerful lifelong truth.
That no structure, no matter how mighty or centralized, is permanent or infallible.
And that impermanence was immediately followed by what? Economic chaos?
Total chaos. The new Russian president, Boris Yeltsin, implemented what was called shock therapy, a super rapid transition from communism to market capitalism.
And what did that involve?
It involved floating the ruble, which has decimated its value, mass privatization of state assets, and crucially, lifting decades of these strict, centralized price controls.
And this transition introduced a concept that's totally fundamental to Western prosperity, but was completely alien to the Soviet system.
Property rights. In the USSR, the state assigned you housing. You didn't own it. It wasn't an asset you could sell or borrow against.
Suddenly, homes transformed into marketable assets.
And the author's family actually benefited from this huge shift. They became the legal owners of a big Moscow penthouse. And this wasn't just a change of address, it was a fundamental change in their economic power.
So why are property rights so critical? I know the Peruvian economist Hernando de Soto talks about this a lot.
He does brilliantly in his book, The Mystery of Capital. De Soto basically argues that strong, formal property rights are the cornerstone of economic development.
Because they provide the incentive for people to invest and innovate.
Exactly. If you know you legally own something, you'll improve it, which increases its value. And that, in turn, fuels investment, job creation, and long-term GDP growth.
De Soto's research in Lima, Peru is the perfect example of this, isn't it?
It really is. He studied these shanty towns where people had physically built their homes, sometimes over generations, but they didn't have formal legal property titles.
They were stuck.
They were stuck in what he called informal ownership. They couldn't go to a bank, use their home as collateral, and get a loan to start a business or pay for their kids' education. All that value was just dead capital, totally locked up.
So the moment those former Soviet countries moved toward legal property, they unlocked huge economic potential.
Immense potential. But this new capitalism also brought a really intense, immediate downside.
Uncontrolled inflation.
Out of control. The author's memory of the ruble devaluation just perfectly illustrates inflation as this sudden, confusing kind of theft.
I remember this part. At age 6, her 5,000 ruble lunch money suddenly became 5 rubles on a new note.
And her mother had to explain that the government had just divided the currency by 1,000 because prices were, quote, skyrocketing. So even though the lunch cost the same number, the trust in the value of the money was just shattered.
And that's the key, isn't it? Inflation is just the rate at which prices rise, causing your purchasing power, what you can actually buy with your money, to fall.
It's often called the most regressive kind of hidden tax because it just hammers people on fixed incomes and anyone trying to save.
And when governments really lose control, you get hyperinflation. We're not talking 3 or 5% a year.
No, we're talking about prices doubling in weeks, or sometimes even in days.
And we have some modern examples of this. Argentina is a tragic case.
A tragic, repeated case since the 1980s. And the root cause is almost always the same. Persistent fiscal deficits. The government spends way more than it collects in taxes.
And then just prints money to cover the difference.
Prints money without any corresponding economic output. By 1989, Argentina's annual inflation peaked at a staggering 5,000%.
5,000. It's hard to even imagine that.
Imagine going to the grocery store and the prices have doubled since last week. That kind of chaos leads to huge political and social upheaval.
And they tried to fix it, right? With the convertibility plan in 91, pegging the peso 1-to-1 with the US dollar.
They did, and it temporarily solved the inflation problem because it instilled confidence. It created a new, fatal flaw. The peso became overvalued.
So their exports became too expensive on the world market.
Exactly. It crippled their trade balance,
Yeah.
generated massive national debt, and it all ended in a catastrophic debt default and financial crisis in 2001. It proved that even tying yourself to the dollar isn't a magic fix if the underlying fiscal discipline just isn't there.
And then you have Zimbabwe, which is kind of the poster child for hyperinflation in the 21st century.
Absolutely. The crisis there, which peaked between 2007 and 2009, was kicked off by these really disruptive land reform policies that destroyed their agricultural sector.
And then, of course, the government started printing money recklessly.
To fund deficits and their intervention in the Congo War. The numbers are just mind-boggling. At the peak of the crisis, the inflation rate meant prices were literally doubling every 24 hours.
I remember seeing pictures of the 100 trillion Zimbabwean dollar note.
The global symbol of worthlessness. The currency eventually just became unusable, forcing the country to rely on bartering in foreign currencies like the US dollar. They officially demonetized it in 2015, and the instability continues. It just shows how hard it is to get that trust back once it's gone.
And finally, a really modern tragedy, the financial crisis in Lebanon.
This one was fueled by institutional corruption. The banks were offering these incredibly high, totally unsustainable interest rates up to 14% to attract deposits from citizens.
Essentially running a giant institutionally sponsored Ponzi scheme.
That's exactly what it was, a Ponzi scheme to cover government and central bank shortfalls.
And the crisis accelerated because of external factors, like tourism drying up.
Right, due to the Syrian civil war, and then the government just printing the local lira to cover deficits, which rapidly drained the country's dollar reserves.
And when that scheme collapsed, the consequences for ordinary people were devastating.
Just devastating. The lira was devalued by 85%. Banks just stopped allowing dollar withdrawals. Basic needs became instant luxuries.
I read that the price of 2 pounds of red meat soared from $9 to $43.
And power blackouts became routine up to 4 days a week. It just confirms the author's childhood lesson. Without strong institutions and fiscal discipline, the story we call money can become a total nightmare.
Okay, so let's bring it back to the U.S. in 2020. The market's immediate reaction to the pandemic was just absolute panic.
Total panic. Investors everywhere sold off assets and just hoarded cash, which created this massive liquidity squeeze.
And Wall Street's immediate reaction was to plead for help, framing the pandemic not as a systemic flaw like in 2008, but as an external act of God.
Right. An act of God that required a massive emergency response.
And that response came instantly from the Federal Reserve.
The Fed, the independent central bank of the U.S., which is supposed to maximize employment and maintain stable prices.
So when the economy contracts, the Fed's job is to step in with stimulus to force it to expand.
And their most powerful tool, the one that really defines post-2008 economics, is quantitative easing, QE.
Let's be really clear about what QE is, because it is often misunderstood. It's not just printing money and dropping it from helicopters.
That's right. QE is the process where the Federal Reserve uses its emergency authority to create new digital money.
Digital money.
Which it then uses to buy government bonds and mortgage-backed securities from large commercial banks and other financial institutions. By buying these assets, the Fed injects huge amounts of cash liquidity directly into the financial system.
And this does two really important things. First, it pushes up the price of those assets, like bonds.
And when asset prices go up, their yields, the interest they pay, fall. This lowers borrowing costs across the entire economy.
And second, and this is critical for our deep dive, it dramatically expands the Fed's balance sheet, and that money enters the financial system through Wall Street, not Main Street.
Which creates an immediate wealth effect for asset holders. And critics, including the author, argue that the U.S. economy never really recovered from the 2008 crisis.
Just propped up.
It was just artificially propped up by QE1, QE2, and QE3. And the 2020 stimulus measures, where the Fed's balance sheet just exploded by trillions, it raised these fears that the entire system was reliant on perpetual intervention, not real productive economic activity.
And along with slashing interest rates to zero and unveiling these huge stimulus packages, the Fed did something else that really exposed the fragility of the banking system.
They changed the reserve requirement.
To understand the impact of that, we have to quickly explain the fractional reserve banking system.
Which is the foundation of all modern banking. So when you deposit $1,000 into your bank, the bank does not hold all $1,000.
Right. Historically, they were required to keep a fraction, maybe 5 to 10% in reserve.
And they lend out the rest, the other 90 or 95%.
And this is how money is actually created in the modern economy.
It is. That loaned out money gets deposited into another bank, which then lends out 90% of that new deposit, and on it goes.
Okay.
The money supply is a multiplier of the reserves banks hold. Modern banking literally relies on lending money that doesn't physically exist in the vault.
Okay, so here's the crucial point. During the COVID-19 panic, the Federal Reserve temporarily dropped the reserve requirement to effectively 0%.
To zero.
A 0% reserve requirement just fundamentally changes the risk calculation for banks.
Yeah.
It means they could, in theory, lend out nearly every single dollar that's deposited.
And this move, more than anything else, highlights the core vulnerability of the entire system. It relies completely on one abstract concept, trust.
If even a small percentage of depositors lose faith and try to get their money out at the same time,
the system instantly breaks down. You get a bank run. We saw it in Lebanon, in Venezuela, and in the regional U.S. bank crises. As the original creators of Bitcoin pointed out, the fundamental problem with conventional currency is the immense amount of trust required to make it work.
Trust placed entirely in centralized institutions.
Exactly.
Which brings us directly to a widely held assumption we need to debunk, money myth number 2.
That banks exist for our benefit.
The reality check here is pretty severe.
It is. Banks operate on a zero-sum profit maximization principle. They are designed to extract value, not to generate mutual benefit.
They maximize their bottom line through interest rate arbitrage, paying you basically nothing on your savings while charging high rates on your debt and all sorts of fees.
No matter who is winning or losing in the broader economy, the bank, which is often protected by government guarantees and policies, almost always comes out ahead.
And this inequity was just so apparent in how the Paycheck Protection Program, the PPP loans, were rolled out.
The initial rollout was chaotic and deeply biased. Large, well-connected corporations and institutions like Ruth's Chris Steakhouse, Shake Shack, even Harvard University, they controversially got millions in loans.
Taking priority over actual struggling small businesses.
Absolutely. Reports confirmed that the larger banks systematically favored their existing wealthier clients and bigger corporate accounts, which delayed access for working-class business owners.
And the result was what we now call the brutal K-shaped recovery.
Picture the letter K. The upper arm, representing financial markets Wall Street, it shot straight up, buoyed by trillions of dollars in QE and stimulus.
While the lower arm, representing Main Street, mass employment, and small businesses, just plummeted.
So while the S&P 500 and the NASDAQ Q were soaring to new all-time highs, defying all economic logic.
The U.S. was simultaneously facing mass unemployment that rivaled the Great Depression. Retailers like Neiman Marcus, J.Crew, and giants like Hertz filed for bankruptcy.
This crisis just definitively severed the link between the thriving financial world and the deteriorating economic reality for most Americans. The wealth disparity became undeniable.
Those with asset stocks, real estate saw their wealth artificially inflate.
Meanwhile, the middle and working classes saw their real wages actually decrease because of rising inflation, forcing them to bear the uneven cost of these massive stimulus policies.
Okay, so let's shift from the macroeconomy to the really intense microculture of finance. The author's early experience in investment banking at TD Bank in 2013. It's a fascinating glimpse into this world.
It's a high-stakes, high-octane environment that really shapes these global decisions. The atmosphere was just intensely competitive, often defined by, well, pervasive testosterone.
Right. The source details the imbalance.
Yeah.
Out of 600 traders on the floor, there were maybe only 3 other women.
And the culture was one of intense hazing, mandatory after-hours drinking, an unspoken rule that if you left before 7 p.m., it was a sign of weakness.
There was also that bizarre detail about the environment itself.
The temperature. Trading floors are notoriously cold, literally. They were designed to keep men in heavy wool suits cool while they worked.
Which forced the few women on the floor, who had to wear thin corporate clothes and heels, to hide personal heaters and even UGG boots under the desks just to stay warm.
These little details just show how deeply entrenched and exclusionary that culture was.
But the rewards, on paper at least, justified the environment. The author recalls co-orchestrating a huge, multi-billion maritime infrastructure bond issuance.
Right, alongside J.P. Morgan. It was one of the largest government-backed bond deals in North American history at the time.
And the success of a deal like that leads to instant, life-altering wealth.
Oh, yeah. The source describes this 2-week celebration after the deal closed, where colleagues immediately spent their bonuses on luxury cars, huge dream homes, expensive jewelry. It's a vivid, real-time affirmation of the potential of traditional finance, if you can stomach the culture.
And the author eventually pivoted out of that world and into the more entrepreneurial, tech-infused world of venture capital.
Working first with the band Linkin Park, and later with the DJ duo The Chainsmokers. And this shift really highlighted a growing trend: the celebrity mogul.
Celebrities realizing they shouldn't just take an endorsement check.
Exactly. By becoming VCs, people like Jared Leto, who invested early in Uber and Airbnb, they recognized that their massive platforms, their audience, their cultural influence, were assets themselves.
So by investing directly, they could leverage their fan bases to amplify a product, leading to potentially massive returns.
Returns of 50 to 100 times their initial investment, yeah.
And the ultimate modern example of this has to be Kim Kardashian.
Without a doubt. She didn't just endorse products. She took control of the whole company building process with KKW Beauty and Skims, and then eventually launched her own private equity firm, SKKY Partners.
And her success is especially notable in a space that is still so heavily male-dominated.
That is a key point. In 2020, only 2.3% of total VC capital went to women-led startups. So Kardashian and others like her are setting this powerful new standard for women breaking through the traditional gatekeepers of finance.
So let's unpack the VC framework itself. The modern model, which was really pioneered by Y Combinator, or YC, revolutionized early-stage investing.
Through instruments like the SAFE contract. A SAFE, or simple agreement for future equity, is basically a flexible one-page agreement that lets founders raise money quickly without having to set a company valuation right away.
So YC just streamlined the whole thing, making early-stage investing faster.
Faster and more democratic than traditional equity rounds. They essentially created an assembly line for unicorn startups valued at over $1 billion.
But this speed and simplicity also brought some serious concerns about long-term sustainability.
Definitely. The VC model grew exponentially, but it has high overhead and a deeply illiquid return horizon. It often takes 8 to 10 years for a fund to see any returns.
And many VCs are actually terrible at generating consistent returns,
They
right?
are. They hide poor overall performance behind a handful of massive, successful outliers.
And the critique gets deeper, doesn't it? The SAFE model introduces elements of moral hazard.
And adverse selection. Because the founder doesn't have to price the company immediately, the risk often gets shifted to the investor, and later to employees whose stock options might be based on unrealistic valuations.
So the whole model prioritizes a quick exit strategy, an IPO, or an acquisition, over building a fundamentally profitable, sustainable business.
The relentless pursuit of rapid scaling and unicorn status over long-term value. Yes.
So looking forward, what are the big trends that will define where VC capital flows next?
We see 3 really distinct trends emerging. First is the proliferation of artificial intelligence. We're just at the beginning of understanding how AI will reshape every industry.
Companies like OpenAI, tools like ChatGPT, they're commanding vast amounts of capital.
As investors race to control the technological foundation of the next economic era, second is the energy revolution.
Solar, wind, battery tech.
The dramatic increase in efficiency is driving down the cost of energy, with some projections suggesting near-zero energy costs in the coming decades. This foundational shift changes every industry, from transportation to manufacturing.
And third,
The computing leap. This pivotal shift from traditional CPUs to GPUs, graphics processing units for high-intensity computing.
which were originally for gaming but now are essential for AI.
Essential for the immense computational demands of AI and machine learning. As Moore's law slows down for CPUs, controlling access to specialized computing power becomes a critical investment frontier.
So all of these core failures we've talked about, the centralized control, inflation as a hidden tax, the instability of the fractional reserve system,
The inherent bias of traditional banking.
they didn't go unnoticed. They led directly to a digital protest, one with a very specific origin story.
January 3rd, 2009, the birth of Bitcoin. And it wasn't some academic exercise, it was a defiant political reaction to the 2008 financial crisis.
And the proof is right there in the code.
It's embedded in the very first block mined on the blockchain, the Genesis block.
The code contained a specific powerful message, a reference to the London Times headline.
Chancellor on brink of second bailout for banks. An unambiguous, time-stamped message criticizing central banks and governments for repeatedly bailing out the institutions that failed the people.
So Bitcoin promises a radically different architecture.
Completely different. It offers scarcity, capped at 21 million coins, which prevents the inflationary money printing we see with fiat currencies.
It offers portability, divisibility, and most importantly, true decentralization.
This is money that is free from government manipulation, verifiable by math, operating outside any single country's jurisdiction. It's often called the Internet of Money because it lets value be sent peer-to-peer, anywhere, instantly.
And the potential application is just enormous. It offers a financial lifeline for the, 6.5 billion people globally who operate in cash-based economies.
And lack access to international finance. And for the 2 billion of those people who already have internet access on a smartphone, Bitcoin offers instant participation in a global peer-to-peer economy.
And the best real-world example of this has to be the extraordinary case of El Zonte, El Salvador.
Bitcoin Beach. This small coastal town was the absolute epitome of a cash-based, informal economy. No banks, few ATMs, heavily reliant on precarious tourism and remittances sent home from abroad.
And the whole initiative began in 2019 after an anonymous early Bitcoin donor,
Who had rediscovered this large, forgotten stash of Bitcoin he'd bought for pennies years earlier, allocated a multi-year 6-figure donation to the town.
And when the pandemic hit and that lifeline of remittances just stopped.
The Bitcoin Beach initiative accelerated out of pure necessity. They started making direct BTC transfers every 3 weeks to about 600 struggling families, covering about half their basic needs.
So stores, restaurants, local services, they all started accepting Bitcoin because they had to.
They had to, which led to the town's first Bitcoin ATM.
But crucial to this success was a specific technology, the Lightning Network.
Yes. Because Bitcoin itself, while it's secure, is slow and expensive for daily microtransactions because of its block size limits.
So the Lightning Network is a layer 2 payment protocol designed to solve that scalability problem.
That's a good way to put it. Think of Bitcoin as the main highway. It's secure, but it's slow because of traffic. Lightning is the network of side roads that enables instant, low-cost microtransactions,
And it does this by creating off-chain payment channels between users.
where multiple transactions can be grouped and settled instantaneously, and only the final balance gets recorded onto the slow, expensive main Bitcoin blockchain.
So without Lightning, a $2 coffee transaction might cost you a $2 network fee, making it totally unusable for daily life in a place like El Zonte.
Lightning makes Bitcoin viable as a medium of exchange, not just a store of value.
And this success story soon got national attention.
President Nayib Bukele watched what was happening in El Zonte and decided to take a radical step. In September 2021, El Salvador made Bitcoin legal tender alongside the US dollar.
Which was a deeply political and economic move.
Absolutely. Since 2001, El Salvador had relied entirely on the US dollar, which meant its monetary policy was dictated by the US Federal Reserve. By adopting Bitcoin, Bukele was seeking monetary autonomy.
Hoping to shield his nation from the inflationary policies and financial instability of the US system.
Exactly. And while the government-designed digital wallet, Chivo, had significant adoption issues, and the cost of property in Bitcoin Beach has soared.
The overall economic bet is still monumental. El Salvador became the first sovereign nation to actively hedge against the traditional system using decentralized technology. It forced the world to pay attention. So after this explosive crypto boom, the author's journey takes her to Dubai.
The Vegas of the Middle East. With its 0% income tax and light regulatory touch, it became this massive magnet for global crypto wealth.
Particularly for those looking to escape tightening regulations or seeking a haven from geopolitical conflicts.
So the author was there to build her personal brand and network after leaving the traditional VC world. And she gets introduced to this figure, Larry Lau.
A character straight out of a financial thriller.
Completely. Larry epitomized the crypto gold rush glamour, taking her to the 7-star hotel, the Burj Al Arab, flaunting his new lavish yacht, the Zion.
And he ran this secretive fund from his penthouse in Abu Dhabi, surrounded by over 40 trading screens.
But this is where the insider knowledge came into play. Because the author is fluent in Russian, she overheard conversations that painted a much, much darker picture of the whole operation.
What did she hear?
Well, Larry's crew included the sons of incredibly wealthy, often politically connected partners. One had deep ties to Putin's Kremlin. Another was rumored to be on the run from Russian authorities for financial crimes.
So the high complexity and opulence, it hinted that this wasn't just a standard tech fund.
No, it was a repository and a mechanism for laundering hidden wealth.
And this anecdote brings us to another pervasive myth we have to dispel. Money myth number 7.
That all cryptocurrencies are good investments.
The allure of getting rich quick in this unregulated space just attracts massive, sophisticated scams.
And Larry's fund, which was built on some obscure derivative of Ethereum with no real tech utility, was nothing more than an elaborate, high-tech Ponzi scheme.
The inherent risks of the crypto world, the extreme volatility, the lack of regulatory oversight, the consumer protection gaps are just brutally exposed here.
And we really need to stress this for you, the listener. Unlike traditional banking, there is no FDIC insurance protecting your crypto funds. If you lose your keys, if an exchange gets hacked, or if you fall for a scam, there's no one to call.
The author's ability to pull her initial investment out just before the whole thing imploded, it made her the few who got out.
It confirmed it was all just a confidence game built on pure greed.
So shifting focus from the chaos of the Middle East to the frontiers of Africa, the adoption story there takes a much more constructive turn.
A far more constructive turn. Africa represents massive financial potential. It has the youngest population in the world and has shown this exceptional aptitude for technological leapfrogging.
And technological leapfrogging means bypassing traditional centralized infrastructure like landline phones or physical bank branches and just moving directly to the next generation of tech.
Usually mobile-first solutions. The prime example is M-Pesa in Kenya. It created mobile money services that bypassed the need for traditional banks entirely.
It transformed financial inclusion and demonstrably reduced poverty rates.
By allowing people to send, receive, and save money securely on basic feature phones, Africa now leads the world in mobile money adoption.
So now let's look at decentralized finance in this context. Fintech attracts about 60% of all crypto VC funding in Africa.
And it's directly addressing the failings of malfunctioning, corrupt, or just inaccessible banking systems for things like remittances and peer-to-peer payments.
And blockchain technology offers transparency and security, which is absolutely vital in regions that are plagued by government corruption or civil instability.
We see this ambition clearly defined by Charles Hoskinson, one of the co-founders of Ethereum, who created Cardano with a mission focused entirely on the African continent.
How does this actually work on the ground? How does a decentralized ledger solve corruption and land ownership issues?
It solves it by creating an immutable, verifiable digital record. In places like Ethiopia, where central agencies might be hard to trust or access, and where land titles are often subject to corruption or arbitrary government seizure.
Cardano seeks to use blockchain to provide users with permanent, verifiable digital identity, credentials, and legal ownership of land.
It's the genius of it. If your land title is recorded on a distributed public ledger, no single corrupt official can just erase it or seize it without massive public consensus.
So by formalizing this ownership, millions of people who currently hold dead capital,
Like DeSoto's shantytown residents,
can now legally leverage that land as collateral for loans, freeing up immense capital for productive investment and economic development, all accessible on their phones.
So, as we connect these financial threads back to the global structure, we have to acknowledge a painful historical truth.
Which is?
Every empire, no matter how powerful, the Roman, the Mongol, the British, eventually falls. And history shows that the primary killer of empires is usually internal division and economic overreach, not external military threats.
And the U.S. empire showing deep fissures. The most visible symptom of that internal distrust was the January 6th Capitol attack in 2021.
That wasn't just a political riot. It was a physical manifestation of profound skepticism in the democratic process and core government institutions, all fueled by misinformation and the "stop the steal" narrative.
The fact that large parts of the population still hold beliefs that fundamentally challenge the legitimacy of the government shows the extent of the disease.
When faith in your system erodes, you start to hear the rumblings of revolution, and the system just loses its credibility to lead the world.
And the foundation of America's current global dominance rests entirely on the U.S. dollar's role as the world's global reserve currency.
This status was first established at the 1944 Bretton Woods Conference, which pegged global currencies to the dollar, which was, at the time, backed by gold.
Then President Nixon ended the gold standard in 1971.
To finance the escalating costs of the Vietnam War and domestic spending, so the dollar needed a new mandate. And this was achieved in 1973 through the petrodollar regime.
Can you explain the petrodollar regime? It's so critical to understanding the dollar's power.
It was an agreement forged between the U.S. and Saudi Arabia. In exchange for U.S. military protection and security guarantees, Saudi Arabia agreed to exclusively price and sell its vast oil reserves in U.S. dollars.
And since nearly every country needs oil.
This agreement effectively forced every nation on Earth to maintain large reserves of U.S. dollars just to conduct international trade, whether they liked U.S. foreign policy or not. It created permanent, artificial, global demand for the dollar.
But today, that global ubiquity is being actively challenged by de-dollarization.
The deliberate global effort to reduce reliance on the U.S. dollar. And this isn't theoretical, it's happening right now.
We have concrete evidence.
We do. China and France trading liquid natural gas in Chinese yuan. The BRICS bloc, now with over 30 interested nations, is actively seeking a new, potentially gold-backed currency to settle trade, bypassing the dollar entirely.
India is settling trade with Russia in rupees.
And this raises the most serious economic question for the average American. What happens if the rest of the world stops needing dollars?
Right.
If the world starts rejecting the dollar, those trillions of dollars that were previously required for global trade, the ones sitting in central banks overseas, they come flooding back home to the U.S. economy.
Which massively increases the domestic money supply.
And without a proportional increase in productive economic output, this influx of dollars acts as a massive inflationary shockwave, sharply escalating domestic prices for Americans and undermining the Fed's already difficult job.
And the U.S. is worsening this erosion with self-inflicted wounds. Domestically, the government has tried to regulate its own tech companies with laws like the Keep Big Tech Out of Finance Act,
trying to prevent major platforms from creating corpo currencies. Meanwhile, China has done the opposite. It has allowed its tech giants to flourish in finance.
WeChat, the mobile super app used by over 1 billion people.
It's the ubiquitous peer-to-peer payment system across Asia and increasingly Africa.
So if China, which makes most of the world's consumer goods, controls the most efficient, cheapest payment system, WeChat, and starts compelling its use for global trade.
The U.S. faces a real threat. They risk losing reserve currency status not through military defeat, but by losing the battle for the most efficient payment rails, which would accelerate the flood of dollars back home and severely undermine American economic stability.
Finally, we have to look at the economics of war, a concept that's often taboo but is essential to global finance.
War, while destructive, often stimulates economies, grants access to vital resources, and can temporarily unify divided countries.
We have to remember President Eisenhower's 1961 farewell address, where he warned of the unwarranted influence of the military-industrial complex.
And we see this influence playing out today. U.S. funding for Ukraine against Russia often serves to replace older U.S. machinery with state-of-the-art equipment, which massively fuels the profits of domestic defense contractors.
And similarly, in the Israel-Hamas conflict, the U.S. provides billions annually, which has led to intense campus protests challenging U.S. involvement.
These ongoing, costly, and often unpopular conflicts abroad erode global faith in the American empire's benevolent status and just deepen internal division.
So after this exhaustive deep dive, what's the core realization? The system is just fundamentally unstable.
The fiat currency structure, resting on fractional reserve banking and centralized control, it's a confidence game, and it's rigged toward perpetual inflation.
And traditional financial wisdom, the old gospel of our parents' and grandparents' generations, is increasingly obsolete.
Completely. The dream of homeownership is elusive for young adults, and savings are relentlessly eaten away by inflation that consistently runs hotter than the Fed's target.
And the FTX collapse was a particularly egregious betrayal of trust. Over $11 billion in creditor assets just vaporized.
It showed that even sophisticated investors are vulnerable.
And while FDIC insurance is supposed to protect consumers up to $250,000, we've seen regional bank failures where even that guarantee isn't always enough. The financial landscape feels like a high-stakes gamble where the odds are stacked against you.
So the answer for navigating this environment, according to financial experts who operate at the highest levels, is not to panic. It's to hedge.
The legendary hedge fund manager Paul Tudor Jones made this case.
PTJ. He made this rational case to his investors in 2020. Recognizing the unprecedented monetary expansion from QE, he argued that hedging a portion of one's portfolio with Bitcoin was a pragmatic defense against accelerating monetary growth.
Because Bitcoin, born out of protest against the 2008 crisis, represents money for people, not for governments.
Its utility is in its scarcity and its decentralized nature. It operates outside the control of any central bank or politically influenced entity. It offers a store of value secured by mathematical consensus.
The mechanism is simple but powerful.
If you hold Bitcoin in a cold wallet, you are your own bank. There's no possibility of a bank run, no one lending out 90% of your deposits, and no central authority gambling with your money. It operates on predictable math, not political whim.
But diversification has to go beyond just crypto. The ultra-wealthy maintain and grow their capital by diversifying far beyond stocks and bonds.
Into real estate, fine art, private businesses, deep tech. And for those of us looking to build sustainable wealth, the focus has to be on sectors poised for exponential growth.
What we call American dynamism.
The technological engine that often props up the whole global economy. Key deep tech sectors include AI and machine learning, the foundational infrastructure being built by giants like OpenAI,
Robotics, which will automate huge swaths of manufacturing and logistics.
and the energy sector, transitioning toward renewables and new battery technologies, which you see in the explosive growth of companies like Tesla. Governments are actively supporting this through strategic policy, like re-onshoring semiconductor manufacturing.
So the abandonment of these traditional stable paths, the recognition that upward mobility is shrinking and savings are just evaporating, has led to what analysts are calling financial nihilism among young Americans.
And this nihilism is rooted in genuine generational pain points. Why bother saving diligently for a down payment when housing prices have just ballooned past wage growth? Why chase a meager 8% return when inflation is already at 6%?
They recognize the game is rigged.
So instead of playing conservatively, they turn to high-risk, high-reward investments, meme stocks, volatile crypto trading, not because they're greedy, but because they are trying to buy their way out of a system that wasn't built to reward long-term stability for their generation.
Ultimately, the source material reminds us that true financial success isn't measured by the myth of money or by maximal profits.
It's about achieving the freedom to live a happy, healthy, and secure life. We have to move past the hype, the volatility, and the short-term illusions, and instead focus on establishing sustainable long-term wealth creation strategies that acknowledge the instability of the system.
The world is in a rapid state of flux. The lessons and wisdom passed down from previous generations, the simple advice of save your money and buy a house, it just doesn't necessarily apply in this new landscape of financial fragility and technological disruption.
It really doesn't.
So what does this all mean for you, the listener? Well, your traditional sources of wisdom, your banker, your teacher, your parents, they don't necessarily know the correct course of action for your financial future in this radically new environment. Stay curious, ask the hard questions about the underlying mechanisms of money, and chart your own path toward true financial freedom. Now more than ever, critical thinking is the best investment you can possibly make.